Hey guys, let's look at the 1960 letter that Warren Buffett wrote to his limited partners. This is from his Buffett Partnership days. He starts off by providing a general market overview. He discusses that the industrial average declined from 679 to 616, which was an overall loss of 6.3% for the index. He then talks about the results in 1960 as far as how Buffett Partnership portfolio did. He says, "My continual objective in managing partnership funds is to achieve a long-term performance record superior to that of the industrial averages. And unless we do achieve the superior performance, there is no reason for existence of the partnerships." So what he's saying is that the portfolio's long-term performance has to be undoubtedly better or superior than the Dow Jones Industrial Average. Buffett then talks about how he would like to be graded, and he says that as long as the portfolio does better than average in stable or declining markets and does poorer than average during advancing markets, he would be quite happy. He then compares his partnership gains with the Dow Jones Industrial Average gains for the past 4 years. As you can see, every year he has been beating the Dow Jones Industrial Average consistently. There were a couple of years when Dow Jones had a negative return, whereas as you can see in his partnership, every year has been positive. Buffett then gives us a picture of what the cumulative results are for his partnership and the Dow Jones Industrial Average on a compounded basis. Buffett then talks about how right now he has multiple partnerships and he wants to consolidate and create one large partnership. Buffett then talks about Sanborn Map, which is a company that he did not disclose the name in the previous year's annual report, but he disclosed the name this time around. He says that the Sanborn Map company is engaged in the publication and continuous revision of extremely detailed maps of all cities of the United States. He says how these maps are crucial for insurance companies since it gives them an idea of what kind of risks is involved with, let's say, the fire insurance, how far the fire hydrant is from the building and whatnot. So the Sanborn Map company was crucial for not only the insurance company, but for public utilities, mortgage companies, and taxing authorities. And he discusses how it was more of a monopoly. And Buffett then talks about how once the insurance industry went from the mapping method to the carding method, Sanborn lost its competitive advantage, and this amounted to an almost complete elimination of what had been a sizable, stable earnings power for the company. Buffett then talks about how back when Sanborn had the monopoly, it was investing in various bonds and stocks, and about $2.5 million was invested in various securities during that time. So even when the earnings power declined, the investment portfolio of the company was actually booming. Buffett talks about how back in 1958, Sanborn was trading at $45 per share, while the investment portfolio of that company was trading at $65 per share. It can all be summed up in this last line where Buffett says, "The buyer of the stock unwilling to pay more than 70 cents on the dollar for the investment portfolio with the map business thrown in for nothing." So Buffett is saying is that there's a 30% discount when we compare the investment portfolio to the current stock price. And on top of that, you're getting the operating business thrown in there for free. Buffett talks more about Sanborn where he says, the income from the investment portfolio was substantial. The business had no possible financial worries. The insurance companies were satisfied with the price paid for maps, and the stockholders still received dividends. He did talk about some of the hardships or troubles that he ran into with the board and how the board's interests did not align with those of the shareholders. And he discusses how people on the board hardly had any ownership within the company. He talks about how 9 of the 14 members had a combined ownership of only 46 shares out of the 105,000 shares outstanding. He says the 10th one held 10 shares, the 11th one held 10 shares, and the next 2 were directors. And so they were the top officers of Sanborn who owned about 300 shares combined. And the president, who had just died, his widow had 15,000 shares of stock. And at this point, Buffett came in and started buying shares. As you can see, he says we made a bid to his mother for her block of shares, which was accepted. He combined forces with another group, and the desire to separate the investment portfolio from the map business was successful. At the end, Buffett talks about how our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected, along with investment in special situations where the profit is dependent on corporate rather than market actions, which he calls a controlled situation, since he can come in and make decisions on the corporate side of things rather than market correcting the price and whatnot. And that is how he ends the 1960 letter. The key takeaways from this letter is that first, Buffett wants to be graded by making sure that his performance is better than the Dow Jones Industrial Average, especially during bear markets. The second is the Sanborn Map Company, where we got an idea of Warren Buffett's rationale behind cigar butt investments and how he found the discrepancy between the current stock price and the company's investment portfolio, and he used it to his advantage to get a profit. And lastly, he is still buying undervalued securities and selling when that undervaluation is corrected. That is all I have for you guys. Please do like, share, and subscribe to my channel. Thank you.